Day trading is not a get-rich-quick scheme, but a serious business. Rule 1. Day trading is not a strategy to get rich quickly. Day trading demands dedication. It requires the right tools, software, education, patience, and practice. Success in day trading comes from 3 important skills: mastering proven trading strategies, proper risk management, and controlling emotions. Like any professional career, it takes time to become consistently profitable, typically 6 to 8 months of dedicated practice and small-size trading. Treat day trading as a business. This means developing a business plan, investing in proper education and tools, managing risk and capital effectively, keeping detailed records of trades, and continuously improving your skills. Day trading is not suitable for everyone. It requires a certain mindset, discipline, and set of skills. Before committing to this career, ensure you have the time, resources, and temperament to succeed in this demanding field. Develop a solid foundation through education and simulated trading. Education and practice give you a perspective on what matters most in trading, how you trade, and how you can grow and develop your skills. Knowledge is power in trading. Start by reading books, attending webinars, and taking courses on day trading. Focus on understanding market mechanics, various trading strategies, and risk management principles. However, theoretical knowledge alone is not enough. Practice in a simulated environment. Use a paper trading account for at least 3 months before risking real money. This allows you to test and refine your strategies without financial risk. Develop your trading skills and decision-making abilities. Experience market dynamics in real time, and build confidence in your trading plan. During this phase, treat your simulated trading as if it were real. Follow your trading plan, manage risk, and keep detailed records of your trades. Only move to live trading when you've demonstrated consistent profitability in your simulated account. Master risk management and emotional control. Rule 6. Your broker will buy and sell stocks for you at the exchange. Your only job as a day trader is to manage risk. Risk management is crucial. Never risk more than 2% of your account on any single trade. This rule helps protect your capital and ensures you can survive losing streaks. Implement stop-loss orders to limit potential losses, and take profits at predetermined levels. Key risk management principles: use proper position sizing. Set clear entry and exit points before entering a trade. Never average down on losing positions. Be willing to take small losses to avoid large ones. Emotional control is equally important. Fear, greed, and impatience can lead to poor decision-making. Develop a trading psychology that allows you to stick to your trading plan even when emotions run high, accept losses as part of the trading process, avoid revenge trading after a loss, and maintain discipline in both winning and losing streaks. Regular meditation, journaling, and self-reflection can help improve your emotional resilience and decision-making under pressure. Focus on high-probability setups and patience in execution. Rule 8. Experienced traders are like guerrilla soldiers. They jump out at just the right time, take their profit, and get out. Quality over quantity in trading. Instead of trying to trade every market move, focus on identifying and executing high-probability setups. These are trade opportunities that align with your proven strategies and offer favorable risk-to-reward ratios. Key aspects of high-probability setups: clear entry and exit points, alignment with overall market trends, confluence of multiple technical indicators, presence of a catalyst, for example, earnings reports or significant news. Patience is a virtue in trading. Wait for the perfect setup rather than forcing trades out of boredom or fear of missing out. Remember, not trading is sometimes the best trade. Overtrading often leads to increased commissions and potential losses. Develop the discipline to stick to your predefined trading plan. Wait for your edge in the market. Avoid chasing trades that have already moved significantly. And be comfortable with periods of inactivity in the market. Utilize technical analysis and price action for informed decisions. The market only remembers price levels, which is why horizontal support or resistance lines on previous price levels make sense, but diagonal trend lines don't. Technical analysis is a powerful tool. It helps identify potential entry and exit points based on historical price data and chart patterns. Key elements of technical analysis: support and resistance levels, moving averages, volume analysis, chart patterns such as ABCD, bull flag. Price action reading is crucial. Understanding how buyers and sellers interact at different price levels can provide valuable insights into potential market moves. Pay attention to candlestick patterns, breakouts and fakeouts, volume confirmation of price moves, market sentiment indicators. Combine technical analysis with an understanding of overall market conditions and sector trends for a more comprehensive view. Remember that no indicator or pattern is infallible, and always use multiple confirmations before entering a trade. Implement a structured trading plan and journaling process. Plan a trade and trade a plan. A trading plan is your roadmap to success. It should outline your trading strategies, risk management rules, entry and exit criteria, daily routine and preparation process. Create a series of if-then statements for different market scenarios to guide your decision-making process. This helps remove emotion from your trading and ensures consistency in your approach. Journaling is essential for improvement. After each trading day, review and record your trades, both winners and losers, market conditions, your emotional state, adherence to your trading plan, and areas for improvement. Use this information to refine your strategies and identify patterns in your trading behavior. Regular review of your journal can help you recognize and correct mistakes, reinforce successful habits, and track your progress over time. Join a community of traders for support and continued learning. To whom can you turn to ask trading questions? Trading can be isolating. Joining a community of like-minded traders provides several benefits: shared learning experiences, emotional support during difficult periods, exposure to different trading styles and strategies, accountability for your trading decisions. Look for online forums, local meetups, or trading rooms that align with your trading style and goals. Engage actively by sharing your experiences, asking questions, and contributing to discussions. Consider finding a mentor. An experienced trader can provide valuable guidance, help you avoid common pitfalls, and accelerate your learning curve. When choosing a mentor, ensure their trading style aligns with your goals. Verify their track record and reputation, and be prepared to invest time and possibly money in the mentorship. Remember that while learning from others is valuable, ultimately, you must develop your own trading style that fits your personality and risk tolerance.